Good morning, everybody. Kirk Spano here. As you can see, I'm wearing a tie, and unfortunately, it's not for a good occasion. I have to go to the funeral of a friend's son. So we will be in and out of here in 15 or 20 minutes. As you can see, brighter news, spring training, only 17 days away. The world gets better in 17 days. As you've been watching me do this week, I've been updating the very short list. So we have a lot more functionality to the spreadsheet, including, and I haven't finished putting in the bottom fishing prices, but I basically spent 3 months updating 5-year price targets. And I did that with a combination of using other analysts' work, Value Line, Morningstar, and then the composite ratings that you find at Schwab and Fidelity and Interactive Brokers. So really those 5-year target prices are based on the work of around a dozen analysts. And then I would adjust the number up or down depending on the cyclicality, the secular trend, and what I knew about the company. In very many cases, there wasn't upside to bother buying. So if you take a look at AbbVie and Abbott, their percentage potential price gain over the next 5 years is negligible. So those pop up in red if the price gain potential over the next 5 years is under 20%. Conversely, if the potential price gain is a double over the next 5 years, it pops up as green. Now, if something actually is below the bottom fishing price, it actually alerts you way over here that you might want to take a look at it. So Disney, for example, and you know that I like the entire streaming space because I think that consolidation is going to add to their margins. I think they're paying down debt. I think they've gotten control of all the expenses or are about to. Warner Brothers Discovery is doing a great job. Paramount is for sale. And I think Disney ends up doing pretty well here. I added another company, and I added some companies, but AMC Networks looks really good here as a buyout target. So I haven't put in a bottom fishing. Oh, yes, I guess I did. $22 as a bottom fishing. But from here, it's got upside of roughly a triple. So I really like AMC as a company that gets acquired. I could see Disney buying these guys. ESPN could be spun off. There's already a deal with the NFL to partially give NFL control of ESPN. So Disney, now that they've made their payments to Comcast for Hulu, is going to make some money on ESPN and then maybe buy something. And they still have TV stations that they can sell. And I think that'll happen as well. I wouldn't put out of the realm of possibility that Paramount has a deal in the next quarter. I think the Paramount is pretty dirt cheap at 13. If I had to give it a bottom fishing price, it would probably be close to that. So when I set up the bottom fishing prices, I'm using the automatic charting feature inside of TradingView, and it just shows you the most prevalent price targets. And Vici Properties hasn't broken out, so it hasn't shown a breakout chart pattern here. I think that right in here, because when you take a look at the volume profile, you want to see where selling would disappear. And it seems like in the middle 20s, you probably have no more real sellers, right? Lack of sellers over here. But also, if it is the Armageddon zombie apocalypse scenario, then your buy zones come in way down here, right? I think that this area here. So you could have a price way below bottom fishing around 20. I don't think that will happen, but that leads me to the theme today, which is pay attention to Jerome Powell. If Jerome Powell is nice next week, then I think that the market is probably setting up for a pretty big rally. If he's mean or scary, then I think you probably have a pretty weak February. However, we know that the first quarter of the year is generally a good time to be invested. That's when all of the retirement money, not all, but most of the retirement money goes into 401k plans from the matching. And that's when an awful lot of people make their contributions. So I would think that keep an eye on Jerome Powell. If the stock market is going to dip, it's going to be because the meeting isn't what people want to hear. However, for those of you who do get FS Insight, I know there's about a dozen of you, their news has been pretty consistent in that inflation is plunging. And this has been a theme that I've been on for gotta be a year and a half now. So I've been in camp, soft landing, inflation is transitory almost since day one. And it would have taken the Federal Reserve to screw up to see anything worse than that 20% bear market that we got, that we've now rebounded from. And in January, the stock market has jitterbugged around the whether or not it's going to set new highs, right? So it's a little to the upside now. However, it's been bouncing around resistance, and resistance is the old highs. And it looks like it's getting ready to break out now. If the Fed is mean next week, or scary, or something bad happens in the world that scares everybody, then you're going to have the market pull back. It's not going to break through, and then it probably breaks through later when the Federal Reserve does start reducing quantitative tightening and lowering interest rates, which I believe is probably going to start in March. It could be one meeting later. However, we are very close to the banks starting to say, hey, we could use a hand. There's probably a few banks that are closer to crying uncle, and Uncle Jay would come to the rescue with money. As we know, liquidity is what drives markets, and we've been tightening liquidity for 2 years, a little over 2 years. And if that reverses, right now, they're still tightening, right? There's still quantitative tightening. If they wind down quantitative tightening to maybe half of what it currently is, and they lower the short end of the treasury curve so that there's no more inversion, that's very good for the banks. There's more lending. A lot of money ends up going into not only real estate assets, but industrial assets and the stock market, of course. So all the cognitive dissonance about how bad the world is wrong. It's usually wrong. Tom Lee actually talks about the infrastructure bill, and I know this doesn't show up very well. However, it shows what's getting a lot of money. Well, one of the things is energy transmission and distribution. That's why I recommended that one particular utility, because they own a transmission company and they are building it out quickly. What you're going to see in the energy grid is a complete denial of what the clean energy bears are constantly pounding their chests about and pounding the table and stomping their feet. Look, the grid in about 3 years is going to coincide with the new factories for EVs and the new factories for solar and the new solar technology and the new batteries. All of these things are moving together so that 2026 and 27 end up being a pretty significant inflection point for the growth of the clean energy economy and EVs. You can not believe me now and hear me later, believe me later, hear me now, whatever. I don't care anymore. I'm tired of arguing about it. Everything that I've been saying about this since 2020 has proven to be true. The stock market is hyperventilating over things that it shouldn't be hyperventilating at. However, I put a column into the very short list, and I want you to pay attention to this. I put this in because I got tired of the question, why did that go up or down today? Oh, I'm just tired of it. Stop asking that question because it's a really bad question. And I know that some people go, oh, there are no bad questions. Bullshit, there's bad questions. Understand what you're doing. Look, percentage of shares traded. If you take a look at this, how many of these have more than 1% of their shares traded in a given day? Look at all those zeros. What does that scream out to you? What moves price? Where does price move? It moves at the margin. So you're not seeing when a stock goes down in price, all sorts of selling, big waves of selling. Even Tesla. Let's take a look at Tesla. How many shares did Tesla trade yesterday? I bet it's about a quarter of the shares. Tesla. 3% of the shares traded. Maybe I was baiting you a little bit there. So Tesla drops, whatever it dropped, $11. I don't even remember anymore, right? Look at that chart. That drop right there is on 3% of the shares. So get over the narrative of the day. It doesn't matter. It's not moving money. Little itty bitty trickles of the retail people running around. They don't know if they're doing. They're bad investors. They're probably even bad traders. Tax records say that 60 to 80% of people who trade lose. And it's usually closer to 80%. So percentage of shares traded. I have this in here permanently so you understand that it's not a lot of money moving. Now, if we see a week where these numbers are all like the Tesla number, right? If we see 3, 4, 5, 6, 7, 8, 9, 10% of money moving, then something's up. We haven't seen that in a long time. What was one of the other themes that I've picked up on that I've been talking to you about for about 4 or 5 months now? That China was going to start pumping all kinds of money into the economy. You had a foreign minister or finance minister over in China say that they needed to support the stock market. Flat out, we need to support the stock market. At least here, we don't say that out loud. We just hint at it, wink, wink, nudge, nudge. If we don't say it out loud, then it's, we maintain plausible deniability, Ali North style. China's going to print money, and they're going to print a lot of it. And that's why, for the first time in 4 years, last time I talked about buying commie stocks was 2020. And then by the end of 2021, I was like, sell all your commie stocks. Well, here we are at the start of 2024, and I am not a China bull the way that I'm a U.S. bull and an emerging markets bull. However, I think you have a pretty good rebound in Chinese stocks coming. And one of the stocks that Charlie Munger was buying right before he died was Alibaba. So there are several ETFs that are heavy in Alibaba and Tencent and a few other Chinese stocks. I'm sticking with the ETFs. I'm not buying any individual Chinese stocks because, you don't want to get on the wrong side of the Communist Party on a morning because you wake up and, you eat the wrong breakfast and they go crazy on you. So I'm not buying Alibaba stock. I'm not buying Tencent stock. I am tracking Alibaba because to me, that's the bellwether. But I would be buying AIA, which is the Asia 50 fund. Or you can buy, if you really want to focus on a China slice, MCHI or KWeb. They should not be big positions, a few percent. However, if you want exposure to Asia, I'm using AIA. And that'll probably end up being about a 6% position at some point. It's not right now. I would like to get confirmation on this money actually getting printed and the Federal Reserve lowering interest rates. I am 1/3 scared of Jerome Powell messing with people's heads next week. I think he's going to say, look, we're going to start winding down quantitative tightening this year. And at some point, we're going to lower rates because the inverted yield curve isn't good for the banks. And the banks could lend more money so that we could build more houses and we could redevelop those commercial office towers. If he has a talk like that, essentially what I just said, the market's going to scream higher. Now, if he comes in and goes, well, we still got to be diligent about inflation, then maybe you have some idiots sell the market off for a few weeks. We'll see. But, and I will show you this week, the valuations in the stock market, excluding the Magnificent Seven and maybe 50 other stocks, are not overvalued. So you have extreme undervaluation in micro caps and small caps. You have undervaluation in mid caps. Most of the large caps in the S&P 500 are roughly fair valued, with about 50 of them being overvalued, and half of them probably deserve it. So we really only have a few dozen companies in the S&P 500 at the moment that are overvalued. Now, that is way different than what I said 2 years ago. 2 years ago, I said 100 to 200 companies were overvalued. Well, we got a bear market. And then we have the passage of time. AI is helping earnings. The rationalization of the labor force, right? There's not big raises going into wages anymore. All those big raises were in 21 and 22 and 23. The raises are pretty much over with. So if you're getting 2, 3, 4, 5% raise in a given year, that's pretty good. There's not going to be a lot more 20 and 30 and 40% jumps in wages. The labor market has rationalized. That's one of the reasons why inflation has been crashing. PCE number yesterday showed that inflation could be under 2% this year. We'll see. Basically, the Fed won. They did it right. Oh my God, but the Fed never does anything right. Sometimes they do. And in fact, I would still argue that all they did during COVID was err on the side of what if this gets worse? And if we do overcome it quickly, which we did, it's just money pulled forward for the next crisis. So we're mitigating the baby boomer retirement crisis by printing all this money for COVID and doing the infrastructure bill and doing the Inflation Reduction Act, which is going to be incredibly positive for American energy. We've been talking about energy independence for a very long time. We've been flirting with it since 2019. U.S. oil and gas production is the highest ever. We're the biggest producer in the world now. So when people talk to you about, oh, Biden's just horrible for the oil and gas industry, that's such bullshit. But he's also really creating a environment where clean energy can thrive. And at some point, with the new batteries and the new solar cells and the new factories and plenty of lithium being developed now, in fact, we have a glut in lithium. Price came down 85%, and it'll drift higher from here. You're going to actually see energy independence in the second half of this decade. And it's going to happen pretty quick as the grid updates and it gets smarter. We talked about transformer orders this week. There's a 2 to 3 year wait to get transformers. There's over a 5-year backlog in projects. If you're a 20-something or 30-something-year-old and you're trying to figure out, where do I get a better job? Man, go work for a utility or a company that's building the grid. They're short on people because nobody wants to sweat a little bit at work anymore. And I say this as a guy who worked construction when I was younger and worked at UPS loading trucks and worked in a meat processing plant. Not the funnest work, but did you know that construction workers have the highest job satisfaction in the country, according to most surveys? Kind of mind-boggling, right? It's because you get to do something tangible, which is why I've talked to you about real estate projects. I love what I do, but I feel better about building something. It's cool to see something get built that you got a hand in. All right, so I'm going to switch over to Shooter. And really my takeaway message is this. Pay attention to the very short list. Each month, I'm going to put up the dividend stocks, the growth stocks, and the grandpa stocks. And the list is going to look like, I have to get a picture of a grandpa. It's going to look like this. The charts are always going to look like this from here on out. What is the secular trend the company is operating in? How is policy affecting them? How are their fundamentals? What do the technicals look like? And the chart. We are going to focus on the companies that are pluses, right? Buy now. You can buy these this month. And then the weights, the ones that I think you'll be able to buy in the next couple of months. At the bottom, I'm going to actually put a list of the companies that are rated sell so that you don't own them. And if you do own them, you can trim them. So this is going to be a very actionable list each month. This is more to prime your research. If you'll notice, the bottom fishing price is attached to a chart, right? Apple. If Apple gets under 100, that means it's the end of the world and zombies are eating everybody. I do think Apple can fall under 140 for a hot minute. I don't know that it's likely, but it could happen. And what we know about Apple is generally every correction you want to buy, because even though they're not going to sell as many handsets in the future, they are going to make more money in media, and they're going to make more money in services, and they're going to make more money in smart homes. But it's going to be lumpy, and people are impatient. So when impatient people sell their stock, and this gets down on a correction, you want to be the patient person who says, are you sure? Are you sure you want to sell that to me at 140 bucks? And then you check to see if you maybe will give it to you at 130. But if we do get a correction down here, it's probably a pretty good buy, because 2-3 years out, as part of the energy transition and the consolidation in the entertainment space, Apple has another rally coming. All right, let's pause here and I will get Shooter on.